Wall Street didn't flip a switch overnight. It did something quieter. It changed its plumbing. In 2025, stablecoins stopped being a side project and became a rule-book business. Banks got guidelines, issuers got reserve requirements, auditors got checklists. And suddenly the path was open for institutions to move real dollars on-chain at scale. That shift is now colliding with another, Ripple building institutional rails. The result is a new market structure where tokenized dollars, treasury systems, and prime services intersect with the XRP ledger and RippleNet. Let's debrief the change and why it matters. First, what changed for stablecoins? Lawmakers drew a bright line. If you issue payment stablecoins in the US, you must hold one-to-one reserves in safe, liquid assets, publish regular disclosures, and follow custody and AML rules. That sounds boring. It's not. It's the difference between "we can't touch this" and "our compliance team can approve this." Banks, asset managers, and fintechs now have a lawful way to put dollars on-chain. That single decision turns stablecoins from a crypto experiment into a financial instrument institutions can actually use. Second, where those dollars will go. Institutions don't move money for fun. They move it for settlement, collateral, credit, and yield. Once a dollar is tokenized with clean rules, it wants to find the fastest, cheapest, most auditable path between counterparties. That is where new rails matter, and where XRP's role begins. Ripple has been shipping the pieces. An institutional stack for messaging and settlement. RippleNet, on-demand liquidity. A dollar stablecoin, RLUSD, designed for instant on-chain settlement and treasury workflows. A prime brokerage footprint through acquisition, so desks can finance, clear, and move collateral against tokenized cash. A corporate treasury front end via GTreasury, so CFOs actually see tokenized balances and can route payments in real time. Put that together and you get a simple story. Tokenized dollars at the front, prime services at the back, and programmable rails in the middle. If the optimal route between currencies or venues needs a neutral bridge, XRP fills the gap. If a direct stablecoin pair is liquid, the system uses that instead. It's not ideology, it's pathfinding. Let's talk use cases. Institutional cash management. A fund needs same-day liquidity after markets close. With tokenized fund shares and an integrated stablecoin off-ramp, they can redeem to RLUSD and redeploy within minutes. No waiting for batch wires, no reconciliation drag. The Treasury desk sees tokenized cash alongside bank balances on one screen, cross-border payables. A multinational schedules payments from the US to suppliers in Asia and the Middle East. The Treasury system prices routes automatically. Sometimes stablecoin, fiat, sometimes USD, XRP, local currency. Always the cheapest, fastest available path with full audit trails. Settlement finishes in seconds, not days. Working capital frees up. Collateral mobility. A trading desk needs to post collateral at venue A, then pull it to venue B an hour later. Historically, that means cut-off times and friction. On modern rails, tokenized dollars and XRP move with finality. Financing costs compress and risk windows shrink. Tokenized market infrastructure. Banks list tokenized money market funds and allow clients to swap fund tokens for compliant stablecoins instantly. Liquidity becomes 24/7. The rails underneath have to interoperate with banking cores, reporting systems, and FX. This is where Ripple's ISO-aligned messaging and XRPL settlement speed fit. Notice the pattern. None of these use cases depend on hype. They depend on reliability, speed, auditability, and cost. That's why institutions are comfortable with them. Where does XRP specifically fit? XRP is a neutral bridge asset with fast finality and low fees. It becomes valuable when it's the most efficient connector between two pools of liquidity. If a direct stablecoin pair is deep and cheap, the system will use that. If not, if you need to jump between dollars and a thin corridor, or you need to settle across jurisdictions fast, XRP can provide the bridge. In a world of tokenized cash and assets, bridging is not a slogan, it's a routing decision. If systems choose XRP frequently, it's because it saves money or time, or both. Why is this happening now? Because the preconditions finally aligned. Legal clarity on stablecoins made tokenized dollars investable. Market structure bills reduced the fog around which agency governs what. Enterprise endpoints appeared, treasury software at the front, prime brokerage at the back. And the tech matured. Ledgers that close in seconds, stablecoins with disclosures, custody that auditors can sign off on. That combination turns crypto rails into financial rails. Let's zoom out. What this means for market structure. Settlement speed becomes a competitive weapon. If you can deliver funds in minutes with finality, you win deals. Liquidity becomes programmable. Treasury can route by cost and time, not bank holidays. Collateral becomes mobile. Cross-margin and intraday financing gets simpler when the asset is digital and recognized by Prime. FX becomes on demand. You don't need to pre-fund Nostro accounts across the globe if bridging is liquid and instant. Audits get easier. Ledgers produce immutable trails. Controls live at the protocol and policy layer. As this takes hold, the narrative around XRP also changes. It's not number go up because buzz. It's throughput go up because usage. The KPIs to watch aren't just price. They're corridor volumes, settlement times, spreads, and the number of named institutions moving flows over these rails. So what should you watch next? Bank-issued or bank-listed stablecoins integrating with enterprise payment networks and listing against compliant USD rails. Prime brokers enabling cross-margin where tokenized dollars and XRP can both serve as collateral with real-time movement. Corporate announcements that treasury systems, like GT-focused platforms, support tokenized balances and instant cross-border payables. Asset manager news where tokenized funds offer 24/7 liquidity via on-chain dollars and begin to connect to external payment networks. Data points showing XRP frequently used as a bridge in hard currency routes where direct pairs are thin. Risk and reality check. This is still finance. Policies will evolve. Integrations can slip. Some pilots won't scale. Stablecoin issuers must maintain pristine reserves. Liquidity must be deep, not just promised. And XRP's role will be earned path by path, corridor by corridor. But the direction is clear, from speculative instruments to operational infrastructure, from can we to how fast can we. The punchline for institutions is simple. If the rails lower working capital friction, reduce settlement risk, and produce cleaner audits, they'll adopt them. If XRP helps do that, often and cheaply, it will see recurring demand without a press release in sight. The punchline for viewers is simpler. Watch the plumbing. Follow the integrations, not the influencers. Track the settlement metrics, not the memes. This is the stablecoin tsunami, dollars going on-chain under rules banks accept, quietly meeting rails designed for speed. In that confluence, XRP's utility isn't a promise. It's a routing choice the system makes again and again. This is the era of utility, and it's already happening. This is not financial advice, just perspective.